Ladies and gentlemen, thank you for standing by. I am Geli, your Chorus Call operator. Welcome and thank you for joining the Cenergy Holdings conference call and live webcast to present and discuss the third quarter 2023 financial results. At this time, I would like to turn the conference over to Mr. Benos Alexandros, CFO of Cenergy Holdings. Mr. Benos, you may now proceed.
Thank you, Geli. Good afternoon, ladies and gentlemen. Welcome to the market update for the 2023 third quarter financial results of Cenergy Holdings. Thank you for joining us on this sunny Friday afternoon in Athens. Without further ado, let's go on to our agenda this afternoon, which is made up of three parts. I'll first discuss a little bit the group key financial figures and then present to you the outlook for the rest of the year and for the coming year. So the results for the third quarter show a very good performance in both segments, cables and steel pipes, and this allows us to confirm and actually to update a little bit the full year profitability guidance that was provided to you at the beginning of this year. The record high backlog that I will talk a little bit about in the coming slides is the major factor that fuels our investment plans for 2024. The important points that I would like to highlight here are as following. First, our revenue reaches 1.17 billion euros for the first 9 months, 12% higher than the previous corresponding 9-month period. And that is achieved even though the third quarter sales were slightly lower compared to the corresponding quarter of 2022. Hellenic Cables continued their growth business, and that was a very good quarter for Corinth Pipeworks, our steel pipe segment. So despite not having a very strong sales number, turnover number, the profitability of the group has reached a very satisfying 145 million due to the improved margins. The 145 million, I note here, they are higher than the whole fiscal year 2022 levels, which were at 137 million. And the improved margins are due to a very good product mix between products of cable products and cable projects, together with the high margins achieved by the steel pipes segment. So we do achieve almost a 16% EBITDA margin on the third quarter. That translates to over 12% on the 9-month period. Coming to the backlog is really our beacon for the future profitability of the group, and I believe it will also be yours, since it is the first time that we exceed 3 billion euros in orders signed and contracts awarded. I remind you that the backlog does not include any orders that we get in the usual sequence of business for the products of cables. It only includes contracts awarded for infrastructure projects and long-term frame agreements with our clients. I'll discuss a little bit more the backlog in my following slides. The improved operational profitability, of course, translates and fits clearly to 60 million, a little bit higher than 60 million consolidated profit before tax. This is compared to a number around 70 million for the whole fiscal year 2022, and therefore we are confident that this year will be a better one. And finally, all of the above conclude to the confirmation of our guidance for adjusted EBITDA to a range of 190 to 200 million. The range that was provided at the beginning of the year was a little bit larger, wider, from 180 to 200. We are now providing a guidance that we will be above 190 million for the full year 2023. The 9-month results, as I told you, are characterized by a very good performance in both segments. Margins have been stronger, though projects are still less than 50% of the total percentage of sales for the cable segment. It is clearly due to a good mix between these high margin projects and the products of cables. This is not something that might be a sustainable level of 16% in the future, but clearly it shows that our shift is now towards the projects business, and this will also guide the margins that you will see in the quarters to come. The adjusted EBITDA, as I told you, was reached 145 million. It was consequently the EBITDA, including one-offs, is at 137 million, and that leads to a profit before tax of 60 million and a profit after tax of 47 million. This large difference between EBITDA and PBT is, of course, due to the importance of interest costs for our group. The change that we had from the corresponding 9-month period of 2022 to this 9-month period, the change in operational profits was around 50 million, from 95 to 145. Unfortunately, most of that 50 million delta was used by much higher interest costs, and only 7 of them have materialized as PBT. This is due, as I told you during the first semester financial results call, this is due to a much higher interest rate that the group is called to pay. I remind you that it was around 2.5 to 3% last year all in, and it's now around 5.5 to 6% for the first 9 months of the year. It is also due to the fact that despite our effort, the total net debt for the first 9 months has not really decreased as much as we were expecting, due to the ongoing investment in the submarine cables factory and the larger working capital needs for both segments. We firmly believe that this will be normalized by the end of the year, and that will weigh positively on the finance charges for fiscal year 2023. Then I turn shortly to Q3 results, to the third quarter results. The turnover, as you see, is not that important, and this is once more a proof that our group, our subsidiaries, are not really chasing after the number of sales. They are trying, as I repeated, or the management repeated in the past, they are always after the good execution of the products, providing good quality products to our clients, being able to give them exactly what they want at the time they want and at the quality they want. So the sales is not really our objective here. On the contrary, profitability is, and this is clearly shown by the fact that with slightly lower sales, even lower than the first quarter of the year, we have achieved a record high EBITDA, adjusted EBITDA for Q3, which of course translated clearly to the trickle down to the top and the bottom line of profitability. Now, all of that, of course, is supported by a very strong backlog. I remind you the backlog at the end of 2021 was 1 billion. We surpassed the level of 2 billion at the end of 2022, and now we're very happy to announce that our backlog on the 30th of September 2023 was over 3 billion, 3.076 to be exact, with the new orders intake during Q3 to actually reach close to 900 million. So the 900 million are new awards during the third quarter that, of course, were adjusted by the execution of major projects by both segments, both cables and steel pipes. that led to a net increase in the order backlog of 500 and something, 550 million. It's important to note here that the breakup between the two segments is a 25-75% breakup. So 1 out of 4 of euros of the backlog is towards Corinth Pipeworks and the rest for Hellenic Cables. But what is more important is that after the 30th of September, as we announced last week, the Corinth Pipeworks was awarded major projects. I would like to draw your attention especially to two of them, the Porthos one and the Neptune one. I give you a list of the projects that have been awarded in the third quarter, plus those in October and November. You see that from those with the asterisk, I draw your attention to the Porthos one, since it is the first carbon capture and storage project that was awarded in Europe, major one, and it was awarded to Corinth Pipeworks. This actually shows our commitment to providing exactly what the market needs and to diversify away from the standard classical gas fuels of the past. CPW, as I've said again and again in the past, has undergone a major restructuring internally and has reviewed from its foundations its business model, trying to forecast and estimate what will be hot in the market for energy transportation in the next decade. That is why it's already very active in the CCS market and in the hydrogen market. And it's also important to note that the last project on that slide, which is the Neptune Deep project related to a deep water gas field in Romania, shows that both movements are done concurrently. So on the one hand, we have the subsidiary moving towards the new technologies, innovating and providing what the clients want for the next energy mix, hydrogen and the carbon capture storage. And at the same time, we provide to our clients very good quality products, steel pipes, to answer their questions about deep water gas fields, complicated projects, where we do really have a very good competitive advantage. That gives us a strong visibility for the future. This backlog extends clearly 3 to 4 years onwards for cables and 1 year and a half for steel pipes. So it gives us very good visibility for the profitability of the future. And also it helps us maintain our top line growth. So we are not expecting any surprises in 24. These, of course, will be discussed much more in detail in our annual results in March. But the fact that we are already booked both segments for all of 24 and forward gives us a much better ease of planning the future, planning our expenses, planning our costs, and planning our production. And in that area is where we are coming with some new investments in both segments. First, as you remember, the expansion of the submarine cables has started in 2023. It is on track. It will be completed by the end of 24 and therefore being operational at the beginning of 25. At the same time, there are other investments coming, not in the submarine cables, but in the land cables business unit. This is due to the fact that, I apologize for that, this is due to the fact that our view for land cables demand is very strong and will be very strong in the future. Why? Because as our CEO also expressed in the semester results. We have, on the one hand, the necessary upgrades to the electrical grids for all European countries, and at the same time, we have a very strong demand for EV chargers all around Europe. These two mega trends will clearly boost the demand for land cables, and this is why we are expecting in 24 to create, on the one hand, a center of excellence in our Thiva plant for land cables, using also the experience and the reputation that we have in the market all around Central Europe, and at the same time using our newly acquired land plot, the old Eleonas land plot from Petzetakis, use it as a center for expanding our land cables production. So what does that leave us for the next year? For at least the remaining year, it is important to note that for cables, we plan on maintaining that improved product mix and the margins, maybe not at the 15% rates, but clearly above 20%. The capacity is utilized throughout the year. This is clear for all cables factories. And the new investment plans I mentioned are here to address the market growth, both in land cables and in submarine. As for steel pipes, the strong momentum is there. CPW has achieved a tier 1 supplier level, so their profitability continues to grow on that strong foundation, and it builds on new products, CCS and hydrogen. So we continue on diversifying our products and our geographical focus, without, of course, leaving out the gas fuels that are here to stay. Gas fuels are expected to be with us for the next 20 to 25 years, which means that the networks to transport these fuels will also be necessary for that same period. All of that leads us to updating our adjusted EBITDA guidance for the year to a narrower range between 190 to 200 million. It's a number, a range, a guidance that we are very confident we will achieve. Of course, the usual assumptions on that are taken. The assumptions are that there will not be a major global environment, although we've seen a lot of changes and a lot of negative events happening in the global environment, that these events have not moved us from our objective, so we continue to believe in that objective. But of course, I have to subject this guidance to the severity of something that might happen in our beloved international markets until the end of the year.